Hello and welcome to lesson number 3 and video number 1, in which I will discuss gold's relationship with bonds. The secular relationship between gold and bonds is not uniform as that between gold and the stock market. Secular bull markets in precious metals have occurred during secular bulls and secular bears in bonds. For example, bonds were in a secular bull market during the secular bulls in precious metals in the 1930s and 2000s. However, bonds were in a secular bear market during the secular bull in precious metals in the 1970s. There is a fundamental explanation for the changing correlation. A weak economic environment of low growth, recession, and deflation risk is bullish for bonds and precious metals. See the 1930s and the 2000s. However, an environment of rising inflation and rising inflation expectations that is stagflationary is bullish for precious metals but bearish for bonds. Consider the late 1960s and 1970s. Gold and bonds are often more correlated than not around cyclical turning points in the economy. When the economy slows considerably or enters a recession, the rate of inflation declines and capital moves out of stocks and into bonds for their security and yield. Bond prices rise. As bond yields fall, the Federal Reserve elects to cut interest rates. Real interest rates decline and gold climbs. Hence, gold and bonds perform similarly before and during recessionary and potentially recessionary environments. Circling back to secular trends, we should note that the secular trend in bonds and yields lasts much longer than in equities and commodities. Since the start of the Great Depression, equities and commodities have had 6 different secular trends. Bonds and bond yields have only had 3 in the last 120 years. In the last chapter, we made a case for why the current macroeconomic environment is similar to the mid to late 1960s. Part of our case included the recent awakening of inflation, which also occurred in the mid-1960s. Bond yields are positively correlated to inflation, while bond prices are negatively correlated to inflation. If inflation has made a secular turn, then so too has the bond market. There is a good chance that the COVID crash in 2020 marked the end of the secular bull market in bonds and low in yields that began in 1982. Let me correct that statement. The COVID crash in 2020 marked the end of the secular bull market in bonds and decline in yields that began in 1982. As shown in Figure 3.1, there has only been one period in the last 100 years of a secular uptrend in bonds. It coincided with a secular bear market in the S&P 500 and the best secular bull market in gold and precious metals. Unlike in the 1930s and 2000s, bonds were in a secular bear market. Bond yields began to rise in earnest in the second half of the 1950s, and bond returns diminished before equity returns slowed in the 1960s. Higher inflation leads to higher interest rates, which are negative for consumers and corporations. These economic actors then face a higher borrowing cost, impacting consumption and corporate profits. The difference between today and the 1960s, the last period inflation began to increase, is that there is dramatically more debt today. According to macro trends, debt to GDP in the U.S. is 3 times higher than in the mid-1960s. Also, according to RBC Wealth Management and Federal Reserve data, corporate debt to GDP is twice as high as in the mid-1960s. In Figure 3.2, we plot gold against bonds total return and gold against the price of the 30-year Treasury bond. Gold against the 30-year bond has already broken above its 1980 high, while gold against the total return of bonds is close to breaking out to a multi-decade high. These ratios signal that capital is already fleeing from bonds in favor of gold. Because of the debt incurred at historically low interest rates, the economy and financial system will have great difficulty absorbing or surviving from higher interest rates. For example, as we publish this video, we see renewed problems in the banking system. The likely policy option to mitigate the impact of higher bond yields is very bullish for precious metals. Many economists and investment professionals see yield curve control in our future. Under such a policy, the central bank buys bonds to keep interest rates at a specific level. The U.S. last employed this policy from 1942 to 1951. Inflation averaged 5.5% per year over that entire 9-year period. Japan has used yield curve control since 2016. The gold price in Japanese yen terms has nearly doubled since that policy started, outpacing gold's performance in U.S. dollars. Finally, although the secular trend in bonds has shifted, there is a high probability of a counter-trend move. As the economy enters a recession, bonds will rally and bond yields will decline. However, the next economic expansion figures to include higher bond yields and at some point, yield curve control. That concludes Lesson 3, Video 1. Thank you for watching. Next up is Lesson 3, Video 2, in which I will discuss gold's relationship to currencies.